Let's paste a link. Hi guys, welcome to our show. We'll get started in a second. Okay, paste this link a few places. Okay, let's get started. I think. So how's the market been? How's the trading been?
It's been rough since we last talked. I would say, one thing that we I think we mentioned briefly, but didn't talk much deeply about was about the quarterly expiry that we had, which was yesterday. Which is, there's a for those people who don't know, the derivatives have this quarter month cycle. So March, June, September, and December, where there tends to be a significant amount of open interest that builds up, and so there's a lot of exposure going into it this week, and so I was pretty bullish last week, and definitely took a bit of a hit as Bitcoin was pulling back, and ETH also quite a bit. So, but it's looking okay again now. It has sort of recovered at least a decent amount, but it was a pretty decent pullback.
All right. So this particular week, right? So if you look on the weekly chart here, the previous week was really it was a down week, and this week has actually been an up week. And as you can see, right after the close, they started buying. And generally, it's a very good sign that at least in the medium term, the market will probably trend up. And generally, if you have two pullbacks very close like this, it can have a very nice long move. Of course, anything can happen. But your point was that so I think last week was somewhere around here, right? So, and the market has been just moving down. You still have another couple of days, right, or 3 days for the expiry. And your belief is that the price will trend up till the expiry. Is that what?
No. My point was we just had the expiry yesterday, and now this has sort of washed out that element where people were computing the max pain, so to speak, where you can take all of the options, put in call options that are exposed, and the strike price versus the current price, and basically the max pain that would have led to the most loss based on this would have been down at 44K. So we didn't quite get that level on Bitcoin, and it was much lower on ETH. But now that open interest is settled, it was about $6 billion worth of Bitcoin and ETH exposure that was settled on that, and that doesn't even include all the futures as well. So all the futures, not the perpetual contracts, but just the fixed maturity futures across all the different venues. Tons of open interest got expired on that as well. So this is, I think, even more bullish now that this is out of the way. We've got a fresh quarter ahead of us now, and I don't think that we're gonna see any more down. I think that it's gonna be smooth sailing from here, and we're gonna continue having nice bullish uptrend continuing.
Right. And in terms of your trading, do you generally look at the like, do you hold swing positions? Do you say I'm going to buy something now and wait for a week, like approximately so many days, and then look for a exit or add-on, or is it like hour by hour? What's your approach to trading?
Yeah. So so in first of all, I have a long-term bull bias. So I'm holding Bitcoin, ETH, and other crypto assets just in spots long term, which I don't plan, especially Bitcoin, which I don't plan to sell regardless of what the price action is. But so that's one thing. So I automatically have just a really long bias there. When it comes to the current market environment, where we're clearly just in general in a bull trend, I'm looking at the weekly chart especially, which keeps me in perspective. Like, if you look at this chart, you can't say, "Oh, I'm going to short this." Like, when has shorting this chart been a good idea? For the past 6 months, it hasn't been a good idea. So I keep it pretty simple when we are trending hard. I go hard when there's a trending market. I just follow the trend. But I got stopped out on my trade, 6 days ago or so. Got stopped out at like 54 on my long, and then I just re-entered around 51. So
somewhere here you got stopped out, or
on the other side, on the other side, yeah.
Right. Yeah.
I always trade, and this is like, this is sort of like a swing-ish position. I don't really scalp much unless it's like super volatile and there's something really, really interesting short term. So I'm, maybe trading with like 3 times leverage or something, and then I always set a stop loss. That just sort of is like, I plan ahead of time, and I put the stop loss there. It got hit. I reassessed. It dropped even more, and that was when I wanted to jump in again.
I see. So your entry is like, is it based on the price? Is it based on the close of a bar? Like, how do you decide that this is the right time to enter?
So when it's a bull market like this, I'm buying the pullbacks. So you can see in the chart on there that there already was a pullback a little bit. Yeah, there exactly, right. And that's what got me interested, and it went up. And then I sort of, and I took it was already sort of falling back, and that's where I got hit in my stop. And then I just wait for, we had what felt like it's the price action really that was driving me, where the selling was pretty hardcore, and I just made the decision to get long at 51, because I thought I was waiting to see if 50 was breaking. 50 didn't break. And for me, that was confirmation. I waited for that to confirm and then pulled the trigger at 51.
Right, especially because this 50 is essentially the price above this entry here. So if you look at this entry, it's they bought just the close of the previous bar. It didn't have any tail. This is a very strong entry. So this is essentially a breakout test. And a breakout test is a very good entry. So I think you did well here. So the way I would trade differently here is that I would not buy this bar at all, because I generally wait for a sign of strength and then buy below that sign of strength. So for me, this would be a sign of strength. This is not really the best sign of strength because of the large tail here. And if this is a sign of strength, I wait for the price to go below this. So I would buy maybe the close of this bar, right? If I was going to trade anywhere here. But in reality, this is the best sign of strength. So if you look at this bar here, it's called a Marubozu. It doesn't have any tail. It's essentially a full body. So and this was right after the close of this bar at a very very good place. So this is a sign of strength. So the close of the next black bar is where I would enter. Similarly here, if you look at this here, this is your sign of strength, and you could buy the close of any black bar here. It would, should not go under this bar. So you could keep a stop here. So, but yeah, this is, my trading style is essentially for moderate trend. In a strong trend, you could really buy the close of any bar. It would just work. Really, anything works in a very strong market, right? As long as you're with the trend. So that said, what I think I'd like to do an experiment is, this is by the way, testnet. This is not a real site. I'd like to place a trade today and see how we do next week, right? So Swapman, so are you saying that we can go long here and expect the price to go above this high? So we could just enter here, try to exit here, and put a stop below this and see what happens, which one hits?
So when you say enter a trade, do we have to enter a position right this second, or we enter an order that could also potentially get hit? If it
we could do, yeah, we could do both or either.
I mean, in this market, I don't think we should short. I think we would have to go long. It's just a matter of, do we long at market right now, or do we place the bid a bit lower, or do we do some combination of both? And then always put in a stop loss so that we're not just like blowing the account.
Okay, I don't seem to have enough testnet here, so let me make a really tiny position here. So I have a position here. This is the close of this bar, and you are suggesting we put a limit order somewhere down here. Okay, at what price?
No, in between the low and where the entry was, so a bit higher.
So somewhere here around 51, something like this. Or just give me a price.
Even higher. Yeah. I don't think it's going to pull. I don't think it's going to retest that.
I think so somewhere here, 52.
Yeah.
Yeah, let's do 52.
I think if we're lucky, that gets filled as well.
Right. So we have the orders, and then do you want to put? You want to stop, right? Where do you want to stop?
Yeah, just below. Like, I mean, if 50 goes, then it's over. For there, we got to start reassessing things.
Let's do 50 then.
And that's a stop market, so it'll get triggered at 50K, and then just boom, unwind the market.
Right. Do you want to put a exit order on the top, or like, do you want to take profit, or do you want to let it?
No, let's let it ride. I think that is, yeah, we gotta let it ride.
Okay, sounds great. And I think we can wrap up the market overview for now. We'll just see how it goes for the, how this works out, and we'll try different strategies and see how it works. So in reality, of course, in a real market, we would not be constrained to trading only on one day of the week, and there'll be opportunities, and there may be a sharp move that can be capitalized. But for the purposes of this exercise, I think this is decent. So let's wrap this up, and let's talk about something else. What do you want to talk about?
I think what a lot of people are talking about this week is Uniswap3, which, I mean, has been one of the most anticipated things. That fund Paradigm has invested quite a bit in them, and also seem to be contributing a lot to improving what Uniswap is doing. And in the case of, I mean, I thought it was going to be an L2 thing. I thought they were going to be doing something on Optimism, but as I understand it, Optimism is still kind of running late. They've still got a few months. They recently delayed it another 3 months. So, like, the number one frustration I think people are having on Uniswap v2 isn't really the inefficiencies of every liquidity provider being basically the same when they're providing to a pool, which is what v3 improves upon. It's, I think, the biggest frustration for people are the fees on chain that are being paid. So I was initially, when I saw it, disappointed can I start with just the things I was disappointed with, just to not to be too negative about it, because I think that they're a great team that has innovated on a lot of different fronts, so I respect them for that. But let me just start with the negatives. I was expecting layer 2 stuff, and that is apparently not in the cards. They did those say that they'll try to get it integrated, down the line or whatever, and they are going to be like in terms of gas efficiency. I guess they are going to be a bit more. A bit more efficient and cheaper, but not remarkably so. The other thing that was frustrating to me was that they used a business license, like was it the business license v1.1 or something for the code, which is very anti-open source. I don't really agree with the idea that Uniswap, which has benefited so much from an open source mentality and culture, is deciding to try and do like this, nobody can use our code sort of license. It just seems very wrong to me that that they would do this. Then I guess the third thing I would complain about is that, well, not really complain, but that they are. So basically, it's they're allowing people to specify price ranges and be more like discriminatory in their how they're providing the liquidity, which means right now, if you add liquidity to a pool on Uniswap, I add liquidity. No matter what our sizes are, no matter what, we're on the same pool. We're combined in the same pool. But in this new one, there's basically it's kind of like the LP tokens, which you receive when you provide liquidity. Right. They're actually sort of distinct. You don't actually you don't have the same pool tokens. You have instead a non-fungible token. I think the LP tokens are actually not ERC20s. They're ERC was it 771?
Right, the non-fungible tokens. Yes.
Yeah. So so that seems like it screws the little guy a bit, because they don't know how to properly add liquidity to this thing. So it's going to benefit the smart sort of sharks who can specify their liquidity in a much smarter way. So yeah, that's my initial take on.
So what is the motivation for this? Are they trying to compete with order book exchanges in the sense that?
Yeah, I mean that's sort of so I was kind of bearish on AMMs years ago when they first were starting to come out, because I'm convinced that central limit order books are the most efficient way to structure a market. I think there's no better way for people to express their interest at a certain price with a certain quantity, and to make a fair and open market. And the inefficiencies of an AMM, where the price only moves if people move the price. People can't specify, they're just stuck with this X times Y equals K formula that the pool is conforming to. It's to me, it was riddled with inefficiencies. But that's what V3 is trying to do, basically, is that they're deconstructing the pool into a bunch of mini pools, you could say, which are specified differently for the same pair, and it's becoming more and more like an order book, basically. But it's still not quite as good as an order book. It's still not the same UX. It becomes much more complicated for liquidity providers, and it'll be better for traders, though, in a way, you could say.
So for what does it mean for me as a liquidity provider? Does it mean that if I say, just let's take the example of a token that's around $10, and I supply liquidity with the condition that, hey, my liquidity only goes into effect when the price goes over $12 or goes over $15. So that way I don't lose my tokens unless I get a very good price. Is that the advantage for a liquidity provider?
Yeah, the liquidity providers can completely control how much risk they are taking. There's no there's no reason for them to add as much funds on either side as they want to be able to provide liquidity. It's closer to like just like if you're in an order book and you're providing double-sided liquidity, which is the analog to adding to an AMM pool. If you're a market maker and you want to quote deep, like if the current price of Bitcoin right now is 54,000 and you want to quote up at 58 for a sell and 51 for a buy, then you're controlling your risk a lot more in this context than if you're just quoting with the prior model. It's just everyone is in it together. It's all the same for liquidity providers, and then every trade is moving along the same curve, and then you are everyone in the pool is sharing pro rata these fees that come about from it. So I mean, I think it's going to be better. It definitely addresses a lot of the concerns that people have had with AMMs before, particularly the constant products type, which Uniswap uses. But Balancer has also taken steps to make this kind of model better. So it shows that overall the automated market making sort of area is getting more interesting.
It is. And if you could extend this concept, like, if you go via for a slippery slope analogy, you could really have many tiny ranges. You could have, it almost becomes like a futures order book where there's like a granularity of, a larger granularity of price. So let's say you could, with the current prices of Bitcoin, you could definitely have an order book where the price difference between the minimum tick move is like $5 or even $10, right? So you could create a AMM with something like WBTC, where every $5 or $10 is a pool, right? If you could create like 100 little brackets, 100 little ranges, right? That would essentially mimic most of the functionality of the order book, right? It's not as efficient as the order book, but it would, given the other advantages of not having to deal with the centralized entity that's running some order matching algo and publishing the trades or anything like that, this would become would this become a real alternative to what we have right now in the markets?
Yeah, I mean, like and I just saw this comment about from Akash saying range increases capital. Yeah, that's like that's the most important thing about this, is that right now, like I said, everyone's on the same level when you're adding liquidity to the constant product Uniswap pools, and you're basically, if you imagine an AMM and you apply it to as if it was an order book, because you can do that, right? Like if you create an order book with orders of sizes and prices which are equal to what the constant product curve would be, basically when you're adding liquidity to the pool, you're creating orders all the way up, like very, very high and very, very low in the book. But why would you do that as a market maker? Like, you want to just focus on getting hit. You want to focus on like quoting closer to where the market is. So instead of using the capital in the pool that would be quoting way far out, that's never going to get hit, you can focus the capital on the areas where you're actually going to get hit and earn those fees, right? That's the whole point, is being able to capture the spread on either side.
Right.
So yeah, I think it's definitely going to be a better tool. I think though that I would hope that for people that aren't as sophisticated, that they'll be able to give people who are adding liquidity sort of the right tools to manage their risk properly, and that they're like, because right now you don't have to think about it when you add liquidity to a pool. You just throw both tokens in, get the LP tokens in return, and then you're on the same pool. But nowadays, like with this new V3, everybody's getting a different ticket. Like, everyone has their own strategy. They're getting their own kind of like, this is my type of liquidity in the pool, which is a very different game to be playing.
Yeah. Would this new arrangement help protect against rug pulls? Like, the issue with one single pool is that uh, so anyone with a large number of tokens can suddenly dump those tokens and take away all your ether. Would this range help protect against such behavior?
I mean, it would allow. Let's put it this way: it would allow market makers to protect themselves from this kind of behavior. But as long as people are providing liquidity far enough down, then people are going to be able to dump into it. But I mean, obviously, yeah. I mean, if yeah, I mean, this is empowering liquidity providers to customize how they're being exposed. So I would think that it definitely will mitigate the rug pulls. But I think that doesn't mean that people aren't going to get scammed and rug pulled on Uniswap.
Right.
That's still going to happen. But yeah, it all else equal, with liquidity providers being able to better customize their risk, they'll be able to protect themselves from rug pulls if they're worried about it. Yeah.
I want to extend this conversation to derivatives products using smart contracts, right? So let's say I think it will be fairly straightforward to have covered calls and cash secured puts or something like this on a smart contract. But would it be possible to have any other kind of derivatives product purely on a smart contract? Like I think Perpetual tried something, but they're subject to like flash crashes because because of the way they're structured. Can you just shed some more light on that?
So when it comes to smart contracts alone, I mean, I know that there's efforts out there like Hedgig when it comes to having options where people are whenever people are buying options, you need to have people underwriting it, and if you're pooling the liquidity in order to underwrite this flow, it's naturally going to be a bit strange to me, and I think that because it's within the smart contract context, you have to make these kinds of compromises, which is why Uniswap is not on an order book; it's just on smart contract. But if you compare the pricing on, just because you mentioned options, I'm focusing a bit on that. But if you look at the pricing of Hedgig options, they're way higher than if you're trading on, say, Deribit or one of the centralized options platforms.
Right.
And that's to compensate for the fact that there's going to be like a toxic flow issue from the people that are you're able to exercise the options, right? They're not European style options. You can buy them and then just exercise them. And yeah, so I think that when it comes to derivatives in general, you need to have high performance, and that's why or at least most of the derivatives exchanges in a decentralized context that I've seen are implicitly using layer 2. So if you look at like DYDX, they're doing Starkware, which is using ZK snarks, ZK rollups on layer 2 on Ethereum. Obviously, the leverage team is using Gluon layer 2 to run its futures perpetual contracts.
Right.
And another one I'll mention, the Perp protocol, which is using XDAI, which is just like sidechain. So you can't really do the logic for well, first of all, having a proper market where people can match against each other, and especially the computationally expensive, like margining that needs to be done, the risk management stuff that needs to be applied. You can't do that in a layer 1 chain, really. Like especially not Ethereum. It's just not economical from purely like you're going to pay too much for fees and stuff like that.
Right. So Gluon is thinking of adding smart contracts to its layer 2 offering, and if there's a way to efficiently create derivatives products, it doesn't need to be a perp. It could be a variety of things. It could be options, for example, which where the kind of risk is determined, at entry time rather than constant margining, right? Like you have some sort of oracle that determines whether the option is in the money or out of the money once it expires. But the cost is a lot less in terms of the things you have to do every second, right? Unlike a futures market or something like that. So so we know certain things are possible on layer 2 on a smart contract. In terms of futures, I'm wondering if there's a way to create a sufficiently similar experience, maybe not the exact same product, but something that gives you like economically equivalent product that enables you to hedge or gain exposure with essentially predetermined risk, like essentially, in other words, like saying something that's like a tight stop or a deterministic stop. Would such a thing be possible, assuming you have a high-speed L2 chain like Gluon?
I mean, yeah, as long as it's as long as it can consume market data, and as long as it has the throughput in order to properly manage the risk, then I don't see why not. It's like when I was saying that it requires layer 2, it wasn't because that it's not the smart contract framework that is the bottleneck. It's the transaction fees interacting with the smart contract on layer 1, which is the bottleneck. So in a layer 2 environment, I'm sure that, I mean, smart contracts is just another way to write code, really. And so as long as there's market data that's consumable to make sure that the pricing is fair and everything like that, and to be able to perform the margin and risk calculations that are needed, then I don't see why it wouldn't be possible. Yeah.
Right. And I think a lot of the expensive operations can be externalized, right? So the smart contract doesn't have to do the margining, or it can be done externally, and some external actor could call a method to create the liquidation or something like that. So in other words, the smart contract only has to worry about who owns what and who stops owning what, right?
So when you say that's usually what also the borrowing and lending protocols like Compound, Aave, or even MakerDAO with the DAI CDPs, is that there's external, like if there's an economic incentive, then liquidity providers will come in and take care of an inefficiency. If I can make good money, coming in and buying someone's bankrupt position, then I'm going to do it. Like, unless there's some kind of reason, the systemic problem that's leading me not to be able to do this. And we have seen problems like that, like in March, right? There was tons of bad liquidations on many of these protocols. The worst was on MakerDAO, where there was Ethereum auctions going for $0. Actually, the MakerDAO protocol allowed for selling CDPs, which were just Ethereum sort of collateral, selling them for $0 in an auction, because it was so bloated on the chain, and everyone was so panicking and dealing with managing their risk in so many different areas that and they didn't code any limitation of not providing an auction at $0, and so people were paying really high gas fees in order to win auctions for Ethereum Ether tokens at $0, which so there are problems with this approach, but they can be mitigated, and there's a lot of lessons to learn from the past about this. But that's the go-to approach that a lot of these different protocols have.
Right. I think that it does make sense that we the lessons learned from the past will be incorporated into future versions. So one of the key things we have learned is that not everything is build once and run forever, right? Everything needs versioning, everything needs to be upgradable. The capital needs to be able to smoothly move from version 1 to version 2. And I think this the market has learned it, and we are going to have products like this, in the future.
Yeah, I mean the point about versioning is it's pretty obvious, but it's worth reiterating. Like even earlier, we were talking about Uniswap v3. Like there's always improvements to be made. There's always, you do the best with the knowledge and the tools that you have at a given time, but these things evolve, right? There's always going to be new information that you need to apply to make new versions. And I've seen this with all kinds of other protocols on different chains as well. Like you can never. I mean, sure, Uniswap v1 still works if you want to use it, right? And Uniswap v2 will still work when it jumps to v3, but in the end, it's their improvements.
Right. I think that's all we have for today. Do you want to discuss anything else, Swapman, before we close?
Well, I was starting to think about, as we're talking about versioning and improvements, I was starting to think about ETH2, but I think that's such a big topic. We should probably leave it till next week because there's a lot to unpack there. And I think a lot of people might also have questions about, like, very, very basic things like what happens to a project when it's migrated to ETH2. Like, does it have to pick a shard? A lot of practical stuff like that. But so, yeah, I think there's too much to talk about right now. So maybe we should park that for next week.
Absolutely. Great talking to you, Swapman, and see you next week.
All right, Brad. Cheers.